What's up guys, Jake here. In today's video, we're going to talk about a very speculative form of investing, and that would be leveraged ETFs. In the event you're not familiar with what an exchange-traded fund is, I have a better video explaining them more in detail. I will link that down below. But an ETF basically acts like a stock. You can buy and sell it in real time on the New York Stock Exchange, except it's not a stock. An ETF is a basket of funds. It can have stocks in it, it can have bonds in it, it can have other kinds of securities or equities inside the ETF that you can buy and sell. And when people discover ETFs, they then eventually discover leveraged ETFs, either 2 times, 3 times, or inverse, negative 2 times, 3 times ETFs. And I had this exact same thought. I know exactly what you're thinking. And on my channel, I tell people all the time that the long-term average of the S&P 500 is about 10% a year. And maybe you've had this idea too. You've thought the S&P 500 index fund with capital gains and dividends reinvested averages in the long run about 10% a year. So what if I just buy a 3-time leveraged S&P 500 ETF? Then I'm earning 30% a year. How can I lose? And of course, I have to break the news to you that that's not how that works. I'm going to explain in detail why in this video. And first, you should know that the major brokerage firms like Fidelity, Vanguard, and Schwab do not offer leveraged ETFs. The reason why is because they are so volatile and difficult to manage. The 2 companies that you can buy leveraged ETFs with, these are the most popular. The first one being PROSHARES. Their S&P 500 3x leveraged ETF is UPRO, UPRO. The other company is Direxion, and their triple leveraged S&P 500 index fund is SPXL. These are very reputable companies. You shouldn't be scared to use their products and services if you want to and you know why you're using them. But how do they do it? How do they replicate a 3x or an inverse 3x return of the S&P 500 index? And I 100% don't understand. I tried to figure this out, but it's very complicated. They have very sophisticated algorithms and very smart people working for their companies, and they use a combination of equity swaps, futures, options, and buying the actual stock to create this 3x return on a one-day time period. What does this mean? It means that the return that you're getting in a triple leveraged fund is not perfect. They can't make it precise. They do their best, but you're not guaranteed that 3x return on a day-to-day scale. Additionally, there are much higher fees. Getting in and out of all these different kinds of securities creates much more fees for the fund managers, so the expense ratios are going to be much higher. For UPRO, their expense ratio is 0.93%. For Direxion's SPXL, their expense ratio is 1.03%. These are the same fees you'd be paying on an actively managed fund. So when you compare this to, for example, Vanguard's S&P 500 index fund, VOO, their expense ratio is only 0.03%. So you're paying 33 times as much in order to participate in a leveraged ETF. Additionally, leveraged ETFs don't pay out dividends. When you look at Vanguard's S&P 500 index fund, VOO, their dividend yield is 1.09%. The reason why is because they actually own the stock. The stock pays out a dividend. The ETF fund managers pay out the dividends to the ETF shareholders. And I know what you're thinking. Okay, Jake, higher expense ratio, no dividend payouts. Who cares? If I just buy a triple leveraged ETF on the S&P, I'm earning 30% a year. I don't need dividends. I don't care about the higher expense ratio. And once again, unfortunately, that's just not how it works. Now, the SEC heavily regulates these leveraged ETFs, and they put out disclaimers. So if you download the prospectus for these funds from PROSHARES or Direxion, they're going to give you like 20 to 30 pages worth of disclaimers, warnings, and explanations why you should not be buying and holding leveraged ETFs over a long period of time. Leveraged ETFs are meant for day traders, swing traders maybe, and the returns of the fund reset every day. it's not trying to replicate the return of the S&P over a 1 week, 1 month, 1 year period. It only replicates it over a single day. And when you reset the fund every day, the numbers start getting a little weird on day 2 and day 3. And I can demonstrate this for you with math. So let's do a 1 week trading comparison between Vanguard's S&P 500 Index Fund, VOO, and Direxion's triple leveraged S&P ETF, SPXL. And let's say that you bought a fractional share or whatever, and you put $100 into this ETF on Monday. And let's say the S&P had a good day and it went up 5%. At the end of the trading day, you have $105 in your fund. Pretty simple. However, the triple leveraged ETF went up 15%. It always has to triple whatever is occurring here. So at the end of the trading day, it has $115. However, the next day is followed by a red day, and let's say the S&P goes down 6%. Subtracting 6% from 105, you go down to 98.7. Now the triple leveraged fund is going to lose 18%, so it's down to $94.30. So right now the triple leveraged is losing. However, on Wednesday we have a green day. The S&P is up 3%. It's gone up to 101.66, and that triple leveraged is gaining 9%. Easy money, right? You're now up to 102, and you are ahead of the simple ETF. On Thursday, another red day. The S&P was down 5%. You're at 96.57%. The triple leverage now has knocked you down to $87 because you lost 15% in 1 day. And then finally on Friday, in order to make this a round number, the S&P was up 3.55%, which gets you back to an even $100. And the triple leveraged ETF is up 10.65%, which gets you to 96.67. So just look at what happened in a 1 week period. The S&P 500 was flat. You started the week at $100. Use any kind of percentages you want, you're back to $100. However, with the triple leveraged ETF, that doesn't happen. You started the week at 100, you ended the week at 96.67. How did this happen? And the industry calls this volatility drag. The S&P 500, if it goes down or if it trades flat over time, the leveraged fund will just lose you money. It has to do this. The reason why is because on down days, when you have a higher account balance, you lose much more. And the market just works in this way. So let's take it to the extreme number. Let's say the S&P 500, this probably wouldn't happen, but let's say the S&P 500 lost 34% in 1 day. What is the triple leverage fund going to do? It's going to lose you 100% of your account balance. Now let's say the next day, the S&P goes up 20% or 50%. It doesn't matter. What is 20 or 50% of $0? $0. It's nothing. You lose everything in this fund if this extreme scenario were to ever occur. And volatility drag is a concern with leveraged ETFs because down days are more likely to be extreme than up days. When you have a green day in the market, usually it goes up 1 to 3%, like 3% would be an amazing day for the S&P 500. That's a lot of money flowing into the market. However, when there's a newsworthy event, when there's a crash, you can see days where the S&P goes down 4, 5, 6, 7, 8% in a day. They have breakers on the New York Stock Exchange to stop that from happening, to let traders reset, to stop everybody's stop losses from triggering all at once. But because down days can be so much greater than your up days, these leveraged ETFs over a long enough time period will just lose you money. And I already know in the comments section that I'm going to have people tell me, but Jake, I've been holding the triple leveraged ETF TQQ the last 5 years, and I'm up 905%. Yes, this is possible. If you hold a leveraged ETF like the triple leveraged Nasdaq, yeah, you might have gone up 905% in the last 5 years. But the last 10 years worth of trading has been an anomaly. Since the 2008-2009 recession, The market has pretty much only gone straight up for like a decade. And is this going to continue? Are we going to have a couple consecutive down years? Are we going to have a serious recession in the near future? If you're holding a triple leveraged ETF when the market goes down or trades sideways, you're going to be in trouble. But as long as it keeps going up, then yeah, you could theoretically get these returns over a 5-year period, which is pretty insane. But once again, just know what you're doing and realize that triple leveraged ETFs are meant for day traders or swing traders, not buy and hold investors. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, consider subscribing if you haven't already. Also, leave me a comment or question down below if you have any. I love hearing from you guys. Till the next video, take care.